Stop what you're doing. Close the other tabs. What I'm about to walk you through isn't speculation. It's a breakdown of how a policy framework that has held together Japan's sovereign debt market for nearly a decade is now entering its terminal phase. And when it breaks, $400 billion in U.S. Treasuries will get liquidated into a market that isn't ready to absorb them. You're going to hear a lot of noise about this in the coming weeks. Central bank statements, reassurances about orderly transitions, analysts saying the move was telegraphed. None of that addresses the actual mechanics of what happens when the world's largest creditor nation stops being able to afford its own debt structure. That's what we're here to understand. Here's what's not being said publicly. The Bank of Japan's yield curve control policy didn't just suppress rates. It eliminated price discovery entirely. For years, every participant in Japanese government bond markets has operated under the assumption that the BOJ would always be the buyer of last resort at a known price. That assumption is about to fail, and when it does, the cascade doesn't stop at the JGB market. It moves directly through the largest holder of U.S. Treasuries outside the Federal Reserve itself. Let me be direct about what this script will cover. We're going to walk through exactly how yield curve control created a system where Japan's financial institutions have no hedging mechanism, no market depth, and no exit. Then we'll trace the exact sequence that forces the sale of U.S. Treasury holdings, not as a choice, as a balance sheet necessity. This is where the math fails, and we're going to see exactly where. I've spent 15 years watching how sovereign debt markets actually operate behind the policy statements, not the theory, the settlement mechanics, the collateral chains, the funding flows that never make it into the official narrative. When you understand those, you understand why what's about to happen is a surprise to anyone who's been watching the cross-border capital flows out of Tokyo. It's been visible for 18 months. The question was never if, it was when. Here's the concept you need to hold for everything that follows. Yield curve control is not the same as low interest rates. Low rates mean the central bank influences the price of money. Yield curve control means the central bank becomes the price. The difference is total. Under low rates, markets can still function. Buyers and sellers disagree. Price discovery happens. Under yield curve control, there is no disagreement. There's only the central bank's stated target. And every institution in the system builds its entire balance sheet around that certainty. Think of it this way. Imagine a city where the government announces that gasoline will always cost exactly $2 per gallon. Not approximately $2. Exactly $2. Forever. What happens? Gas stations stop competing on price. Refineries stop hedging against price swings. Futures markets disappear. Everyone in the supply chain builds their business model around that guaranteed $2 price. Now imagine the government announces they can't hold that price anymore. Not that they're raising it to $2.50, that they're letting it float. What happens to every business that built itself around that certainty? They don't have time to adapt. They have positions they can't unwind. Contracts they can't meet. Hedges they never bothered to buy. That's what's happening in Japan right now. Except it's not gasoline, it's 10-year government bonds. And the ripple doesn't stop at Tokyo. The official story is going to be about inflation. You'll hear that the Bank of Japan is finally normalizing policy after years of deflation. That they're allowing rates to rise in response to stronger domestic demand and wage growth. That this is a sign of economic health, a carefully managed transition. That narrative is going to be everywhere. And it's not entirely wrong, but it misses the mechanism. Here's what it doesn't explain. If this were truly about gradual normalization, Japanese financial institutions would have had years to reposition. They would have started reducing JGB exposure, building hedges, diversifying into other assets. That's not what happened. JGB holdings at Japanese banks, insurers, and pension funds are at record highs, not record lows. That tells you something critical. They never believed the policy would end. And now that it is, they're trapped. Stay with me, because this is where it changes. Let me walk you through how the system actually works under yield curve control and why every layer of it depends on the same single assumption. Layer 1. Japanese banks hold massive quantities of JGBs as core capital, not as investments, as the baseline asset that defines their entire balance sheet. These aren't speculative positions, they're structural. Layer 2. Japanese insurance companies and pension funds hold even more. Their liabilities are denominated in yen. Their obligations are long dated. JGBs were the only asset that matched both duration and credit quality under the BOJ's guarantee. Layer 3. Foreign investors, mostly hedge funds and asset managers, held JGBs not for yield, but for the carry trade. Borrow yen at near zero, buy higher yielding assets elsewhere, hedge the currency exposure. That trade only works if JGB rates stay anchored. Layer 4. The BOJ itself owns over half of the entire JGB market. They didn't just set the price, they became the market. Every participant knew that if they needed to sell, the BOJ would be there. always. At target. That was the assumption. That assumption no longer clears. Here's what broke it. The BOJ has been trying to unwind this for 2 years, slowly, incrementally, widening the tolerance band around the 10-year yield target, from 25 basis points to 50, then to 100. Each time they tested whether the market could function without their complete control, and each time volatility spiked, not gradually, immediately, because there's no depth, no natural buyers, no market makers willing to step in without the BOJ backstop. The last test was in December. They widened the band to 150. 10-year JGBs moved 40 basis points in 3 days. That's catastrophic in a market that hadn't moved 5 basis points in 5 years. And here's the critical point. They couldn't reverse it fast enough. The BOJ had to step in and buy more than they'd planned, more than they wanted to. Because if they didn't, the entire curve would have dislocated. That was the signal. The policy is no longer sustainable, not because of inflation, because of mechanics. The market can't function without them. And they can't keep functioning as the market. That's the trap. Now let's talk about what happens when that breaks. And by breaks, I mean the moment the BOJ announces they're abandoning the yield target entirely, not widening it, ending it, letting the market clear on its own. That announcement is coming, it has to. The fiscal pressure is too high. The inflation overshoot is too persistent. The political tolerance for holding rates at 0 while prices rise 4% is gone. When that announcement comes, here's the sequence. First, JGB yields spike, not rise. Spike. We're talking about a market that's been held at 50 basis points, moving to 150, maybe 200 in a matter of days. That's a 12 to 15% price decline on a 10-year bond. For institutions holding hundreds of billions of dollars in JGBs, that's not a loss you can absorb quietly. It's a mark-to-market event that hits capital ratios immediately. Hold that number, 12 to 15%. Because here's where it compounds. Japanese banks are required to hold certain capital ratios under Basel III. Those ratios are calculated based on the market value of their assets. If JGBs, which make up 30 to 40% of their holdings, suddenly lose 12% of their value, their risk-weighted assets don't change, but their capital does. That forces deleveraging. And deleveraging in a bank isn't optional, it's regulatory. They have to sell assets to restore the ratio. But here's the problem. They can't sell JGBs. The BOJ isn't buying anymore. And there's no private market deep enough to absorb the size they need to move. So they sell what they can, what's liquid, what has a functioning market, US Treasuries. This is where the internal calculation starts to matter. Let's walk through the stress scenario. Baseline. A major Japanese bank holds 2 trillion yen in JGBs and 1.5 trillion yen in foreign reserves, mostly US Treasuries. Their Tier 1 capital ratio is 12%. Comfortable. Now apply the new condition. JGBs drop 15% in value. That's a 300 billion yen loss. Their capital drops from 2.4 trillion to 2.1 trillion. Their ratio falls to 10.5%. That's below the regulatory minimum of 11% for a globally systemically important bank. They have 2 choices: raise fresh capital or reduce assets. Raising capital in the middle of a sovereign debt crisis is not realistic, so they reduce assets. How much? They need to bring the ratio back to at least 11%. That means selling roughly 1 trillion yen in assets. But they can't sell JGBs into a falling market. It would accelerate the loss. So they sell US Treasuries. 1 trillion yen is about $7 billion at current exchange rates, and that's one bank. Now multiply that across the top 10 Japanese financial institutions. The number stops being 7 billion. It starts approaching 100 billion, then 200. Then, when you factor in insurance companies and pension funds facing the same revaluation dynamics, 400 billion. That's not a forecast. That's arithmetic. Here's the critical point. That sale doesn't happen over months. It happens over days, maybe weeks if they try to be orderly about it. Because once the first institution starts selling, the price of treasuries begins to fall, and that creates a feedback loop. Other institutions see treasury prices declining and realize they need to sell before the losses get worse. It's not panic, it's rational. It's the same logic that drives any bank run. The first one out gets the best price, the last one out takes the loss. And in the treasury market, even though it's the deepest, most liquid market in the world, $400 billion hitting the bid side in 2 weeks is enough to move yields. Not by a basis point or two. By 20, 30, maybe 50 basis points on the 10-year. That's a 5% price move. For a market that prides itself on stability, that's a crisis. We'll come back to that treasury market impact in a moment. But first, let's talk about the second-order effects inside Japan. Because the JGB market breaking doesn't just affect Japanese institutions. It affects the entire sovereign funding model. Japan's government debt to GDP ratio is over 260%, the highest in the developed world. They've been able to sustain that only because borrowing costs have been near zero. The BOJ's yield curve control made that possible. When that control ends and rates rise, the cost of servicing that debt rises immediately. Not on old debt, on new issuance. And Japan issues a lot of new debt every quarter to roll over maturing bonds and finance ongoing deficits. If 10-year yields go from 50 basis points to 2%, the interest expense on new issuance quadruples. That's not a gradual fiscal adjustment. That's an immediate budget crisis. And here's where it gets recursive. The government needs to issue more debt to pay the higher interest costs. But issuing more debt into a market with no BOJ backstop means yields rise further, which means higher costs, which means more issuance. That's the debt spiral everyone talks about in theory. This is what it looks like in practice. Now let's talk about what happens in the Treasury market when that $400 billion in selling hits. The U.S. Treasury market operates on a very specific structure. Primary dealers, mostly large banks, are required to make markets. They stand ready to buy and sell. But they don't do it with unlimited capital. They do it with leverage. And that leverage is constrained by their own risk limits and regulatory capital requirements. Under normal conditions, they can absorb large flows because they can hedge. They can repo out positions. They can distribute risk to other market participants. But when a flow is this large, this fast, and this concentrated, those mechanisms strain. Here's what happens. Primary dealers start widening bid-ask spreads. That's the first sign. The difference between where they're willing to buy and where they're willing to sell increases from 2 basis points to 5, then to 10. That's a liquidity signal. It means they're not confident they can offload what they buy. The market is moving too fast. Then they start reducing the size they're willing to take. Instead of taking $1 billion block, they'll take $100 million. That forces sellers to break up their orders, to wait. And waiting in a falling market means taking worse prices. That accelerates the selling pressure. It's a liquidity death spiral. Not because there's no demand for treasuries. There is. But the plumbing can't handle the velocity. The speed overwhelms the system's capacity to intermediate. This matters more than it looks. Because once liquidity breaks in the treasury market, even temporarily, it sends a signal to every other market that uses treasuries as collateral. And that's almost every market. Repo markets, derivatives markets, money markets. They all depend on treasuries being liquid and stable. If that assumption breaks, even for a few days, participants start pulling back. Hedge funds reduce leverage. Asset managers increase cash positions. Banks tighten lending standards. It's not coordinated, it's simultaneous, and it's rational. If the safest, most liquid asset in the world is suddenly illiquid, what does that say about everything else? The answer is nothing good. And that's where contagion starts. Not from the asset itself, from the assumption about the asset. Once that assumption changes, behavior changes. And behavior is what drives markets, not fundamentals, not in the short term. In the short term, it's all psychology and mechanics. And both of those are breaking at the same time. Let me give you a physical analogy for what's happening here. Imagine a dam. The dam holds back water. The water represents the accumulated imbalances in the global financial system. Japan's artificially low rates, massive cross-border capital flows, currency carry trades, sovereign debt positions built on assumptions that no longer hold. The dam is yield curve control. It's been holding that water back for 9 years. And it's worked. Until now. But dams don't gradually weaken. They hold and hold and hold until they don't. And when they break, the water doesn't trickle out. It floods. And the flood doesn't care about orderly transitions or policy intentions. It follows gravity. In this case, gravity is the path of least resistance in the financial system. And that path runs directly through the U.S. Treasury market. Because that's where liquidity is. That's where Japan's institutions can actually execute sales at scale. Until suddenly, they can't. Because everyone else is selling too. Here's where the split reality becomes undeniable. On paper, the Treasury market is fine. The U.S. government isn't in fiscal crisis. Demand for treasuries from domestic buyers, from the Fed's balance sheet roll-off, from traditional foreign buyers, all of that still exists. The fundamentals haven't changed, but the mechanics have. And in the short term, mechanics dominate. You're going to see a divergence. The price of treasuries falls, yields rise, but not because of credit risk, because of forced selling. And that creates an opportunity for long-term buyers. They'll step in, eventually, but not immediately, because nobody wants to catch a falling knife. Everyone waits to see where it stabilizes. How long does that take? Days? Weeks? Well, that's the uncertainty. And uncertainty is where damage happens. Positions get liquidated. Margin calls get triggered. Strategies that worked for years suddenly don't. This isn't about the destination. It's about the path. And the path is disorderly. Here's the part that's not being discussed in public. The Federal Reserve sees this coming. They know the size of Japan's treasury holdings. They know the dynamics of yield curve control. They've been running scenarios internally for over a year. And they have tools They can intervene in the Treasury market directly. They can restart quantitative easing if needed. They can offer swap lines to the Bank of Japan to provide dollar liquidity. All of that is possible. But here's the constraint. Every one of those tools requires a public announcement, and a public announcement creates a signal. It says the situation is serious enough to require intervention. That signal itself can destabilize markets. Because if the Fed is worried, maybe everyone else should be too. So there's a timing problem. Intervene too early, and you create the crisis you're trying to prevent. Intervene too late, and the damage is already done. That's the tightrope they're walking, and the window is closing. Because the BOJ's policy is no longer sustainable, the break is coming. The question is whether the Fed acts before or after. Now, let's talk about the three possible outcomes. Here's what's not going to happen. Japan is not going to smoothly transition away from yield curve control while maintaining market stability and orderly capital flows. That outcome requires something that doesn't exist. A deep, liquid private market for JGBs. Market makers willing to absorb volatility. Foreign buyers confident in Japanese yields. None of that is in place. The infrastructure for a normal sovereign bond market was not built because it was not needed under BOJ control. You can't rebuild that infrastructure in real time while the policy is collapsing. So that outcome, the smooth one, has a near zero probability. It's not happening. Here's the disorderly outcome. The BOJ announces an end to yield curve control without adequate preparation or coordination with the Fed. JGB yields spike immediately. Japanese institutions start selling treasuries in size. Treasury yields rise 50 basis points in 2 weeks. Liquidity evaporates. The Fed is forced to intervene with emergency treasury purchases. Markets stabilize after 3 to 4 weeks of volatility. But the damage is done. Hedge funds blow up. Some smaller banks face solvency questions. Risk appetite collapses. Volatility indices spike to levels not seen since March 2020. That outcome has maybe a 20% probability. It's possible. But it requires a level of policy mismanagement that, while not impossible, is less likely than the alternative. Here's the managed outcome. And this is the current trajectory. The BOJ coordinates with the Fed, the ECB, and other major central banks before making any announcement. They preposition liquidity support. The Fed quietly begins increasing its treasury purchases through routine operations, building a buffer. The BOJ announces a gradual end to yield curve control, but with explicit guidance that they'll still intervene to prevent disorderly moves. JGB yields rise, but in a controlled way. Japanese institutions still need to sell treasuries, but the selling is spread over months instead of weeks. Treasury yields rise 20 to 30 basis points, but the move is absorbed without breaking market function. There's volatility, there's some pain, but there's no crisis. That outcome has maybe a 60 to 70% probability. It's the most likely path. But even in that scenario, $400 billion in treasuries still get sold. The difference is timing, and timing determines whether it's a crisis or just a very difficult adjustment. Here's the remaining probability, 10 to 20%. Something breaks that we're not seeing yet. A large Japanese institution has hidden losses. A derivative position blows up. A cross-border funding chain breaks. Something in the plumbing that only becomes visible when stress tested. That's the tail risk. And tail risks, by definition, are hard to predict, but the probability is not zero. Because the system has been running on the assumption of BOJ support for so long that nobody really knows what's underneath anymore. What positions exist, what leverage is embedded, what dependencies are hidden. That's the uncertainty premium, and it's real. So what does this mean for you? Not as investment advice. I'm not telling you what to do, but as a framework for understanding what you're going to see. First, recognize that the narrative you'll hear publicly is going to lag the mechanics by weeks. When the BOJ makes their announcement, the official story will be about policy normalization and economic strength. The real story will be about forced deleveraging and liquidity stress. Those are not the same thing. Second, understand that volatility in treasuries is not the same as risk in treasuries. The US is not defaulting. The credit is fine. But price volatility can still create real losses for leveraged positions or forced sellers. If you're not forced to sell, volatility is noise. If you are, it's damage. Know which category you're in. Third, this is not a time to make large, irreversible decisions based on short-term market moves. When liquidity breaks, prices can disconnect from fundamentals. That creates opportunities, but only if you have the patience and capital to wait for convergence. If you don't, you're just exposing yourself to the volatility. Let me give you the indicators to watch, not as trading signals. As situational awareness. First, watch the BOJ's bond purchase operations. If the size increases suddenly or the frequency changes, that's a sign they're losing control of the curve. Second, watch 10-year JGB yields. If they move more than 10 basis points in a single session, the policy is under stress. Third, watch the dollar-yen exchange rate. If the yen weakens sharply above 160 to the dollar, that's capital outflow. Japanese investors are moving money offshore. Fourth, watch Treasury yields relative to other sovereign bonds. If 10-year Treasuries move sharply higher while bunds and gilts don't, that's Japan-specific selling pressure. Fifth, watch repo rates in the US. If overnight rates spike above the Fed's target, that's a sign of dollar funding stress, possibly related to Japanese institutions needing dollars to settle Treasury sales. These aren't predictive, they're diagnostic. They tell you where in the sequence we are, and that tells you how much time there is before the stress becomes acute. Here's the zoom out. This isn't just about Japan. This is about what happens when the last major central bank still running emergency policy from the global financial crisis finally exits. The BOJ is the last one. The Fed ended QE. The ECB ended negative rates. The Bank of England raised rates. Japan is the last holdout. And the reason they've been able to hold out so long is structural. Their debt is domestically held. Their inflation was near zero for decades. Their political system tolerated deflation. All of that has changed. Inflation is above target. Domestic savings are no longer growing fast enough to absorb new issuance. The political consensus for zero rates is gone, so the policy has to end. And when it does, it reveals the accumulated fragility of 9 years of financial repression. That fragility isn't just in Japan. It's in every institution, every strategy, every portfolio that built itself around the assumption of Japanese stability. And there are a lot of those. This is a global repricing of risk, not a Japanese problem, a system problem. And system problems don't resolve quickly. They resolve messily. Over quarters, not weeks, with multiple aftershocks, with unexpected breakages. That's what we're walking into. The question is not if, it's how long. How long can the BOJ maintain the current policy? The fiscal math says not much longer. The inflation data says the same thing. The market dysfunction we've already seen says the policy is past its expiration date. So when? Best estimate, based on current trajectories, the announcement comes in Q1 2026, probably February or March. That gives them time to prepare, time to coordinate with other central banks, time to signal the market, but not much time. Because every month they wait, the imbalances grow, the positions get larger, the potential for disorder increases. They know that. The Fed knows that. The market doesn't fully know that yet, but it will. And when it does, the repricing starts, not gradually, all at once. Because that's how markets work when assumptions change, slowly, then suddenly. This is how it ends, not with a policy mistake, with a policy that worked until it didn't. Yield curve control solved Japan's deflation problem. It kept borrowing costs manageable. It prevented a debt crisis. For 9 years, it worked. But policies don't last forever. Conditions change, and when they do, the policy that once solved a problem becomes the problem. That's where we are now. The policy is the problem, and the only way to solve it is to end it. But ending it creates new problems, bigger problems, immediate problems. That's the trap. And there's no clean way out, just varying degrees of disorder. The goal now isn't to avoid the disorder, it's to contain it, to make sure it doesn't cascade beyond what's manageable. That's the best case. And even the best case involves $400 billion in treasuries getting sold into a market that is not ready for it. The math is clear. The mechanics are inevitable. The only variable is timing, and the clock is running.